Wealth can be measured in many ways. As it grows, life can quickly become complex, creating the need for more focused planning. Welcome to We're Talking Money with OmniStar Financial Group. OmniStar has been helping clients achieve financial success for more than 20 years in a client-centric and stress-free environment. With a reputation built on a long track record of working with people who want to grow and protect their assets, OmniStar illuminates the blind spots and provides actionable strategies to help you achieve what's most important. This is where you can count on straightforward and unbiased advice from a team of professionals that are passionate about your success.
All right. Welcome to another edition of We're Talking Money Live, our show that's dedicated to illuminating blind spots in wealth management and financial planning. I'm Phil.
Sorry, I woke up this morning with that tagline in my head.
Did you really?
I did. I just wonder if clients and people who listen think of that. Illuminating the blind spots, that tag.
I sure hope so.
I hope so, too.
We put a lot of thought in that tagline, and yeah, I hope so. Hey, I'm Phil Clark, your host, and Sarah Haynes, our great co-host. Heck, she probably will be the host eventually because I'll walk off the set one of these days thinking I've got something better to do. So welcome. Here we are with a great show. Now, I probably won't for a while. Still enjoying this stuff too well, and I like the new studio.
Yes, it's fabulous. It feels very professional.
We've got a lot of glow going on here this morning, huh?
Yes, we do. Yes, we do.
Hey, we've got a great show today. We're going to be talking about Form CRS. We alluded to that last week as we talked about the SEC and not the version of SEC that the Southerners like to think about, which is all about football or sports.
They don't just think about it. They praise it.
Oh, my gosh.
is huge.
It's an occult, right?
Oh, yes, absolutely.
I mean, this thing is a big deal. But we're talking about Securities and Exchange Commission, which is the governing body that oversees our industry, our profession. And we opened the show last week with that topic. And so today we're going to carry that topic forward just a bit. We're going to dig into what every consumer needs to know about, and that is a required form referred to as the Form CRS.
Client Relationship Summary. If you're wondering what that acronym stands for.
We're full of acronyms in our business. Gosh, it's ridiculous. I don't know if we can keep up with them. There's so many.
Oh, time out. We'll have to do a full show about that.
I remember one day we were on a show and just acronyms for designations and licensure. You said there was over 200.
Oh, yeah, maybe 270. It was insane.
Nuts.
But that's a good show. I think that people would enjoy hearing, especially when you're speaking with people outside of the industry. Even within our firm, we have the DSO arm of OmniStar now. There are acronyms that they don't immediately know.
Yeah.
So I know clients feel the same way, and listeners probably feel the same way. So we should do a show over that.
Sarah, it's a great point. I think that could be a show. In fact, there are days that I have to stop and think about an acronym when someone throws one at me, and I'm around it every day. So if I have to think once in a while, I can only imagine what the consumer or what the average listener to not only this show, but just someone who's trying to get themselves a little more immersed in the world of finance. There's a lot of stuff to know out there, and the acronyms don't necessarily make it easier. So, but we're going to talk about CRS, Client Relationship Summary. And this form is all about helping the consumer have a better relationship or at least make a better decision when it comes to selecting a financial advisor or a wealth management firm or maybe just a broker, someone to help them with transactions. That might be what they need. But Form CRS came into being about a year ago. It was talked about for a long time and came into really a passage of law last year that said, hey, you've got to use it. And so it's out there now. I don't know how effective it is at the moment because I think it's still new and people are not using it. But we felt like you should know, and whether you work with our firm or not, it's a good thing for you to know because it's going to help you be better educated as it relates to choosing what will be someone that you have to get really close to, you have to trust and know and like. They're going to be helping you with some very consequential decisions. So,
absolutely. And you don't know what you don't know. And that's the whole point of this form, is to put it in simple language for anyone to understand. We're going to go through 11 questions today that are on the form, consistent from our firm to a firm in Indiana to a firm in New York. Everyone is using this. Everyone has the same language on there, the same examples. So it allows the client to, when they do their interview process, to determine who they want to work with, to have consistency.
I can speak for our firm anyway. Most of our clientele comes by way of referral. And because of that, the form CRS sort of happens automatically long before it was necessary or long before it was required. And what I mean by that is, as a client would often educate a new client long before that person stepped through our doors. They would help them understand who we are, what they can expect from us. And that always made Form CRS more of a kind of a normal thing for us, even though we didn't know it was going to one day be something that was required. But once someone's in the doors of a wealth management firm or a financial planning firm, you really need a series of questions that will help you better understand if that is a really good fit. I say it a lot, we should never try to fit a round peg in a square hole. And I think Form CRS helps the consumer eliminate the possibility of that occurring. So these 11 questions, they don't change. In fact, I remember starting on our Form CRS with our compliance team, and I didn't like the dollar amount that the SEC put in question. What is it? It might be question number 6. Yep. Mm-hmm. So question 6, they gave us $100,000 as the static number. That's what we were to use for the calculation. Well, I wanted something that was more in line with our average account size. Mm-hmm. And so I built the answers around that. And immediately our compliance team said, wait a minute, you can't change the numbers.
They said, Mr. Compliance Officer.
Yeah. They said, you're supposed to know
back.
that. Right.
Revert.
Exactly. Revert. But here's the crazy part. It didn't dawn on me that we couldn't use what was more appropriate for our firm. We had to use what the SEC said you have to use. And that's it. No questions, no change. So go. If you look at a Form CRS, the answers will be different. Might have some similarities, but the questions don't change. So
they do not. All right, let's go through these questions.
Let's do it.
That you will see if you are interviewing wealth advisory firms. And the first question is very broad. Given my financial situation, should I choose an investment advisory service? Why or why not?
It's a great question.
Oh, yeah. And we preach planning all the time and planning early and being prepared. We also preach, as Phil just said, that we are not a good fit for everyone. So this question really sums all of that up and says either I do need this full-blown financial advisory service and the fees that I pay are justified, or maybe you're at a point in life where you don't need a full-blown plan. You just need to get started.
I think this question opens a pretty broad door, because a lot of folks hear the word financial planning and they think that's way beyond what I need. And others hear it and they think it's not enough. I might need something a little more comprehensive. Well, financial planning is a part of wealth management. And there's certainly, you can get as broad as you want, but here's the bottom line. I meet a lot of people, Sarah, you meet a lot of people that don't think they need full-blown financial planning. They're the very ones that do. They don't realize how complicated their financial life is. Mm-hmm. So part of knowing whether or not you need our service or services like ours is really understanding your situation and then talking to someone who can help you really identify where the strength and weakness is in that. So it's illuminating blind spots. And so at some level, a firm can tell you, oh, sure, you need our services, or maybe you don't. But at some level, the consumer has to take responsibility and really be willing to say, here's my situation, be completely open about it. Otherwise, you put us at a disadvantage. We can't make a good assessment and tell you how we can help, or maybe that you don't need our assistance if we don't truly understand your situation. So it's really on both sides. Mm-hmm. We have to be open and transparent with the client or the potential client, but they have to be open and transparent to let us know exactly what they have.
Absolutely, absolutely. Speaking of transparency, question 2 is focused on how will you choose investments to recommend to me?
Yeah, I've found that this question has been alive and well since I've been in this profession. So almost 30 years, I've heard that question. So to have it on a form doesn't surprise me. To have it as a mandatory question doesn't surprise me. In fact, I think it's requisite when you're choosing someone. So glad to see it. But one of the things that I learned early on is when I sit the 8 ball on the table in front of clients, the magic 8 ball, I always noticed they got a little uneasy, and that was my way of breaking the ice. When they would ask that question, I would reach over and put that 8 ball on the table, and I would say, "Well, it takes a lot of experience, and it takes a lot of effort. But when all else fails, I go to my trusty magic 8 ball." I don't use that anymore, though it still sits on my desk. But that didn't really give a lot of security, or rather confidence, to the onlooker, if you will. But I do think it's important for people to ask that question because, look, there's a lot of investment programs out there. Some are boilerplate. It's a one-size-fits-all. Others are highly customized. Some have mutual funds that carry lots of fees. Some have individual stocks. Some have a combination, exchange-traded funds. There's so many things to choose from. This is not a world of simplicity anymore as it relates to investments. And that's before you get into things like derivatives or options. That just adds more and more confusion to the end user. And so we have to be able to break that down. But if they don't ask the question, they may never know.
Right, and you'll see consistency across the industry. Some firms will just purely use a risk tolerance questionnaire. It's not something, if you go to one advisor, they don't have the magical risk tolerance questionnaire. I will just go ahead and lay that on the table. I'm not going to guarantee it. But I'm pretty sure that no one has the magical risk tolerance questionnaire. It takes so much work to know how to really invest someone. A lot of times when we are walking through, because we also use the risk tolerance questionnaire as one of our pieces, when we're walking through it, many times clients don't understand the question. So imagine not understanding the question, doing a risk tolerance questionnaire, passing that over to your would-be advisor, and they put you in investments that don't fit your true strategy or goals.
Yeah, no truer statement than that. And what I've seen through 3 decades of doing this, Sarah, is people, and this is human nature. This isn't because the questionnaires are bad or not effective. The problem is when someone's answering a question, it's hard for them to think of their future self. Mm-hmm. They think now, and they answer the questions. They might be 35 years old, and the question says it's asking about retirement, and that's going to be 30 years from now. But they'll answer the question as though they're getting ready to start retirement tomorrow. Well, there's no way that you're going to be in the right investment program. It's going to be far too conservative.
Mm-hmm. Absolutely.
So got to be careful of that. So a questionnaire is not a bad thing, but I don't believe it's the end-all, be-all. And so many of the softwares that are on the market today that wealth managers or
robo-advisors.
Yeah, so many of these things. So financial planners use them, and they look like they are doing the best job for their client, but what they're really doing is using a boilerplate set of questions, never changes from client to client, and they don't dig beyond that. They take it at face value, and here's why. And I think listeners need to know this. They do it because it's a CYA. It is covering their rear end as much as it covers the client, and it doesn't really cover the client. As long as that advisor fills out that form and has them sign it, then whatever the advisor recommends, consistent with the scoring of that little form, the advisor is pretty much in the clear. And I don't really think that's how wealth management or financial planning should be done, because it goes far beyond a simple questionnaire. There must be much, much more in-depth discussion. There must be a greater or deeper relationship. If you don't have those things, I'm sorry to say that a 6 or 8 or 10 question risk tolerance questionnaire is not going to get it done.
No, you're probably going to fail. Our next question is going to be, what is your relevant experience? So that's going to include your licenses, education, qualifications. And this one is critical. And Phil has always made a good point about this. Licenses, we have to be licensed to be able to make recommendations. That's just at the foundation. Anything above and beyond that is extracurricular. However, we always talk about, you can have all the designations in the world. You'll see people's names on their websites with all these acronyms, as we talked about earlier in the show, and you have no idea what they mean. But you immediately think, oh, well, they've tested here and there and this and that. What does it mean?
It's a great point. What does it mean? And you see so many of them. There's AIF, and there's CFP, and there's CIMA, and there's CHFC, and
you could say the wrong one. It's probably one.
Oh, and it's probably one.
There's an SMH. Just
yeah,
that's
I mean, there's. Oh, that's right. There's an SM. I like that. That's a pretty good one. Yeah. There's so many, and what do they all mean? I'll tell you what they mean. They mean that someone took the time to read some curriculum, and they were able to pass a test. That's what it means. Now, did they get some structure from that? Did they get some good information? Did they get some nuggets that'll help them plan? Absolutely. The curriculum is very good. There's no question about that. But nothing trumps experience. Nothing's going to take experience and overturn it as a thing that would be a secondary item. Experience is number one. So going to get the licenses, I've always believed, is part of it's requisite. Part of it is simply saying, I want to learn more, and so it's a learning opportunity. But nothing really takes the place of experience. So education's great. Got to have your licenses, otherwise you can't be in the business. But you got to gain experience. And I see 20-something-year-olds coming into our industry, and they get a little bit of success under their belt, and all of a sudden they think they know it all, only to find out they make a wrong move for a client, whether it's investing, whether it's a recommendation of something, and it can come back and bite them pretty hard, which is why these forms are now so important, and it's why there's more oversight at the firm level. As a chief compliance officer, I have to make sure that everybody is doing appropriate things for our clients and looking at all of these pieces that affect a client's outcome. And if we miss on some of those things, the client has every right to lay blame on us. It's our job to know and to know more and to bring the right recommendation.
Absolutely. So that next question is, what do these qualifications mean, which we just covered that. We will do a show over these, and that way maybe when you go to interview your advisor, you will already know what they mean. You go in there equipped with the knowledge.
Man, that is a great point, Sarah. I remember, I won't digress too much, but I recall my youngest years in Rotary International. I walked into a meeting one day. I was the president of this club. I was 30 years old, and an engineer was visiting from another part of the state. Mm-hmm. And he asked me what I did. That's the normal question in this world. When you meet somebody, you want to ask them what they do. And I think it might be one of the worst questions to ask, because who knows, what if they're unemployed, or what if they are maybe a little bit ashamed of something that set them back in life. I don't think it's a great way to start a conversation. Nevertheless, he asked me about my profession, and I told him. He said, "Oh, well, I'm thinking about working with this CFP where I live." And he said, "Are you a CFP?" And I said, "Well, no, I'm not." And he said, "Oh, well, then what would you say about me, or what would you say to me to get me to work with you? Because a CFP, it seems to me like they really know more and they have a lot more to offer." And I said, "Well, I got a question for you. How long has your CFP been in business?" He said, "Well, he just started his practice, and he just got his designation. But," he said, "don't you have to go through a lot of school for that? And wouldn't he be more equipped?" And I said, "Well, not exactly." I said, "I'd take experience over a test any day." And at that time, I had almost 10 years under my belt, and the fact that this guy had a CFP was the least of my concerns. My biggest concern was that client, or that person that I was speaking with, had maybe been misinformed. Mm-hmm. And so he was going to put all of his confidence in a credential, mm-hmm. but he knew nothing about the person's experience or ability to plan based on his set of circumstances. So I think you have to be able to pull that apart and look at it and not just get caught up in this notion of acronyms that seem really cool and high end and academic. Maybe they are, but that doesn't mean you're going to have a successful ride with that advisor. So you have to be careful.
Absolutely. And the point of the form CRS is to engage in conversation. So when you're asking these questions, dig deeper. And I think we always recommend have a notepad, take notes. You're never going to walk away from a meeting and say, well, Philip Clark has this, and this, and I know what those mean. So I'm going to make sure, I'm going to compare him to the other advisor. Take notes, understand, the conversation, the really true points that you want to take home with you.
So important. I'm 50 years old, and I don't think I've had a designation on my business cards in a long time. In fact, I rarely use a business card anymore. But I never really thought that my career would rest upon a designation, no matter how many books I read or how much school I attended. I really just didn't feel that way. And I think today we have a lot of folks in our industry, in this profession, that they get a designation and they think it means automatic success. And I think you can get a little too cocky like that, and it can come back to bite you a little bit. So client should be, or the consumer should be aware of those things. And really, I'd say it to advisors. Don't be too confident just because you get a credential. You got to have a lot of experience, because you're going to see clients throughout your career, and everyone will have similarities, but everyone will be quite different.
Absolutely. So all of these conversations to start can be overtaken by someone that's charismatic. Someone can mislead you in these beginning questions. Yep. The next question, though, is numbers. Numbers don't lie. This is another one. Make sure you write it down, because different firms charge different fees. So the next question is, what fees will I pay? And this isn't just, an assets under management fee. It's not just the mutual fund fees that you never will see. There's so many different ways that you can be charged when you work with an advisor that you have to know before you engage in the relationship. You have to know what you're going to be paying for.
Boy, there's no part of our profession that gets more attention than this one.
True.
And fees are they're somewhat nebulous because they can be hidden. And so I think you have to ask these questions no matter who you're interviewing. You want to know how you're being charged, and then you want to know where the layers of fees live, because it may be that you have an advisor that says, well, I just charge you based on your assets. We do that. Mm-hmm. We also charge an hourly fee if it's more appropriate, or we might charge a retainer fee if it's more appropriate. So we have the ability to do all those things. It's up to us to help you understand what all of that looks like. I think the problem in this area of identifying who it is that you may ultimately work with is they might tell you that it's an asset-based fee, but if they're putting you in mutual funds or exchange-traded funds or UITs or other types of investments, unit investment trust, by the way, UIT, another acronym. But if they put you in any of these things, there's additional fees associated with those things, either in the way of commissions potentially, but more likely something called a 12B1 or an expense ratio. And these things can be 0.15%, so minuscule, not something that you'd be real concerned about, but some of them can be as high as 2%.
Oh, yes. And clients I've yet to meet a client that knows and understands expense ratios until we point it out to them.
They don't. They think whatever their advisor is charging is it. Mm-hmm. But it's if you have a mutual fund with a brand name on it in your portfolio, Alliance Bernstein, American Funds, whatever it is, those folks don't work for free. And so they are charging you something internally, but until recently, so many firms were not required to share that with you. It was up to you to know it. And how many of you recognize this term, prospectus? So in the mail, once you invested with these people, you'd get this prospectus that was 400 pages long. The print is super fine. The
it's usually
pages
gray, too.
Oh, it's always gray.
Yeah, it's awful to read.
They're terrible. The pages are super thin, and most people never crack the spine of those publications. But that's where you'll find the fees that are part of a mutual fund or any other fund. But if you don't read it, you don't know. And the advisor was not required, and some are still not required, to tell you what the fees of that fund are. What they're required to do is ask you a tolerance questionnaire and be sure that it is suitable. And if it's suitable, then so be it. Doesn't matter what it costs. To me, that's a real problem in our industry, and it's why we're a registered investment advisor, because we don't have the luxury of ignoring that part of the conversation. We have to talk about fees at every level, and I really prefer it that way, because I never want someone to come to me and say, "Oh, your competitor told me this." I want them to know that we told them.
Absolutely.
And it just to me, that just builds a better relationship. But believe me, folks, look deep, look carefully. There's a lot of fees that can be embedded in your investment program, and if you don't know how to find them or you're unsure, call someone like our firm, call OmniStar, get a second opinion. We can pull that stuff out for you pretty quickly, share it with you, and then you might not do business with us. We wouldn't tell you that you necessarily need to, but you'd be armed with the right information to go back and have an even more meaningful conversation with your current advisor.
Absolutely. And the next question plays off of the fee question is, if I invest $100,000 with you, what do the fees look like there? What are the costs? What's going to be invested? What's going to be in cash? That's the question that Phil tried to go in and customize, and the SEC said, I don't think so.
Yep, they made me change it back to $100,000.
We're in control. We
100%.
Yeah, the buck ends with us. But that's another question. Make sure you write it down. But for consistency purposes, you go to an advisor, ask, how's my $100,000 going to be invested? What are the fees associated and the cost? And then you go to the next and ask the same question. Yeah. So you can compare very easily between the two of those.
Yeah, and I think it's important for you to compare that part. If you don't compare anything else, compare that, because depending on how they invest for you, your fees could be, it could be $1,000 a year. Mm-hmm. But depending on the instrument that they use, it could be $10,000. There happens to be products out there that an advisor or a financial planner could sell you that could have commissions that run as high as 10%. I've seen them higher. So you need to know that. And the interesting thing is that some of those products with that commission, they don't have to disclose it. So if they say to you, we're not going to charge you anything, we're just going. We use tools that don't charge you anything. The issuing company pays us, and so you don't have to pay for that. That sounds good, but folks, if it sounds too good to be true, it probably is. So when someone tells you something like that, that's the biggest red flag that you'll ever see, and I hope that you'll recognize it. You should run, because there is no such thing as a free lunch, period.
Right. The next question brings us to, what are your conflicts of interest and how will you address them? That could be a conflict of interest. You know, if you are getting a commission, we have insurance agents in our office. If we sell insurance, we let the client know, yes, we do get a commission off of this, but that is a conflict of interest.
Yeah, it really is, because if something pays someone 5 or 10 or 20 or 30% commission versus, say, 1%, you've got to keep that client for a long time for 1% to equal the 10 or 15 or 20 or 30. But there's these products have those kinds of commissions, and so you need to ask those questions. Now, I'm not saying that the commission is necessarily a bad thing every time. Where the problem comes in, it's not the commission. That's how those products are built, and the insurance companies have been very successful doing it that way. There's nothing wrong with that.
Right.
What's wrong with it is that if disclosures are not made, you'll never know if they're recommending that product for your best interest or theirs. And that is a consequential decision that you have to make, but you have to know the information before you can make the decision as to whether it's right or wrong.
Yes, and we always fall back to planning. If your advisor can't show you a true plan and why a product fits your plan, that's another red flag. If they can't prove it and show you numbers, use the Monte Carlo, use their planning software like we do, then that's definitely a red flag. They might be hiding something, or they're trying to fit you somewhere so that they benefit more.
Couldn't have said it better myself. Look, when you're making big decisions, if nothing else, get a second opinion. Have someone else take a look at it. If you have any doubt, get a second opinion. Firms like ours do second opinions all the time. We enjoy that. It gives us a chance to meet new people. You may not do business with us, but you'll be better informed. We can assure you of that, and that's going to help you make better decisions.
Oh, yes. Education is key. So, next question 8. As a financial professional,
spit it out, Sarah.
Do you have disciplinary history? For what type of conduct?
Well, that choked you up a little bit.
I know. You think I'd have something on my
I better
history.
check your U4. That was a little sound like you had a little bit of a frog in your throat there.
Well, here's the good thing. You can go check my U4. Anyone can.
It's
it
true.
Is public knowledge. The SEC, another thing that they do with us, they know everything about us. They know where we've been, where we've lived,
Yep.
any complaints against us, any disciplinary history. You can find that. All you have to have is the internet.
Everywhere we've lived,
Yeah.
everywhere we've worked.
The years and the months where we lived there.
Yeah. All of that's recorded, and that's there for a reason. When you come into this profession, you think, man, this is really getting personal, but it's for good reason. We're dealing with people's money. We're dealing with their life, and no different than a doctor. We're more external. The doctor happens to be more internal. But listen, we're dealing with a person's, what I like to always call the rest of their life money, and we're helping them make decisions that are going to absolutely affect outcomes. And so if we're not doing a great job, then that client is going to feel it. The SEC believes it's important for our information to be out there because it keeps things transparent. It levels the playing field. Look, if someone's done some egregious things, if there are things out there that have harmed investors, that have harmed the public, I think you deserve to know.
Absolutely. And we spoke about experience earlier. When you have a certain amount of experience in the industry, how high would you say the chances are that you have some disciplinary history?
The chances are high. Yeah, there's no question, because you get clients with selective memory. You get clients who wanted things to turn out differently, or they decided that they really wanted to take more risk, even though what they said, early in the relationship is they didn't want to take more risk, or vice versa.
Right.
So that happens, yes, 100%. And usually those are not the kind of disciplinary things that will cause you to not do business with that person. The things that we're talking about are where you have seen someone use products in a way to pad their pocket versus take good care of the client. It's those kinds of things that are more egregious, where the advisor could have made a better decision and they simply chose what was going to do more for them or what was going to benefit them more versus looking out for the client. And really it's incumbent on us to do the right thing for the client. So, and I think that's what the SEC is going for here, but disciplinary action. And listen, let's be honest about this. The SEC is going to make you put virtually anything out there. It can be something very small. It can be something very large, and everything in between. But they want to record it for purposes of real disclosure, and I think that's a good thing. But buyers have to beware. This is helping them be more aware without having to walk through life wondering, gosh, I hope I'm making a good decision. This is designed to help them make a better decision at the outset. But I will say this, Sarah, that doesn't mean that you relax or you let your vigilant shield down, right? Once you get into that relationship, you still need to verify and ask questions from time to time. Hey, is everything okay with your firm? Is everything still in good standing? Has anything changed? And then go out and find the research, or they can do the research and find those answers. But 4 or 5 years goes by, you're real comfortable with who you're working with. Doesn't hurt to do a little checkup.
Yeah, do a little checkup. Be your own doctor.
That's right.
But one of the things, too, again, this is all about conversation. So talk to the advisor that you're meeting with. We always recommend when you work with a team, go talk to the CPA. Go ask them how they feel about you working with me. I think I told Phil recently, I would be 100% confident in saying to a client with our alliances, go ask them if they think you should work with me and then come back and make your decision. And if your advisor can say that and they work with a team and they've explained any history that they have on their U4, then they're being transparent, which builds trust.
I think that's a great point. You don't want to judge someone because there might be an infraction there. There might be a little something wrong, or what you perceive as wrong. It could be something that's easily explained. It could have been something that was totally a misunderstanding, something that truly was innocent, that didn't turn out the right way. But the SEC doesn't always see it that way. If those things occurred, they're going to force you to put it out there, and it's hard to get them expunged. So for good reason. But I think it's very important that you don't throw the baby out with the bathwater, so to speak. Do your research. And if the person if they're transparent and other folks do business with them and the alliances, the CPAs, the attorneys that you work with, let them vet them.
Absolutely.
It doesn't necessarily mean you don't do business with them. Just simply means you've done your homework and you're making a better decision as a result of doing that homework.
Absolutely. So next question, number 9. 9 and 10 go together. So who is my primary contact person, and are they a representative of an investment advisor or a broker-dealer? And this is just knowing your people. So know who your person's going to be, know who to go to with any questions, know who's going to have their hands on your investments and in your planning. This is just, again, an awareness to know who to reach out to and who your primary contact is.
Yeah, it's important because RIAs are different from a broker-dealer. Brokers and dealers, just listen to the way that sounds. A broker and a dealer, they tend to work on both sides of the market. In other words, they're working for the retail end user, if you will, the retail customer, but they're also making a market for themselves. So it's a broker and a dealer, and that's not the worst thing in the world. I worked with broker-dealers early in my career. The first half of my career, I traded through broker-dealers. But an RIA, on the other hand, we can't make a market. We can't do anything ahead of a client. We can't do anything that would be considered trading in advance of the client or things that would benefit us that we were not willing to do
for the client.
Mm-hmm. So I think you need to know the differences. And so there's RIAs, there's brokers and dealers, there's broker-dealers. Just understanding that there's custodians and there's a number of things. We'll talk about that in some subsequent shows, but you got to know those things because not knowing them can lead you to working with someone who really wasn't, not so much that the person wasn't a good fit, but that type of institution or organization really didn't deliver to you things that were consistent with what you're trying to achieve.
Right. You need to know your key players. And the last question, 11, is who can I talk to if I have concerns about how my primary person is treating me? So this is another key player in your group of advisors. And just know there's always a compliance officer that you can complain to.
Yeah, it's so true. One of the things that every client or every consumer needs to know, if you're working with a wealth management firm, financial planner, broker-dealer, doesn't matter. Everyone in our profession, every firm out there, we all are required to follow a certain regimen of compliance. And if you don't do those things, it's not going to matter. You're not going to have a conversation with them about their Form CRS because they won't be in business very long. But it's a good thing for you to know that you can go above your advisor. So whoever it is you're working with, they have someone that they have to answer to, whether it's their office manager or if it's their compliance officer or the SEC perhaps. So be aware of that. And if someone is not treating you well, or you feel like you didn't get everything that you thought you should, or maybe you feel like something's a little off.
Yeah.
Reach out to that person or to the firm and request to speak with the compliance officer. And I promise you'll find out if you have a legitimate thing to talk about. And if you do, they'll tell you the steps to take so that you can be heard. So it's very important to understand that it's not just your advisor that you're talking to.
Very true, very true. Well, that is a wrap for today. We all know tax season is looming. It's already at the forefront of everyone's mind. All I've heard about is profit sharing. Can you get my documents to my CPA? Blah, 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 blah. It's wonderful, wonderful time of year. But we are working
for us.
Well, yeah.
But for them, they're in a tizzy.
They are,
the client's
true,
in a tizzy because they wait to do all of this stuff at the last minute.
True.
And then they run around like they're just out of their minds trying to get it all done. So for us, there are days it doesn't get so fun because we just get inundated. But
that is true.
But you're right, Sarah. Tax season is just around the corner. Mm-hmm. I was making notes this morning, starting certain things that I want to talk about on the upcoming show, where we're going to do a couple, I think, tax shows. This GameStop trade.
Oh, Lord have mercy.
Listen, there's a serious problem going on right now. CPAs are inundated with new customers because people that were trading GameStop, they have no idea what the tax implications are. They had no idea that this short-term trade that they were doing could be taxed as much as 37%. They had no idea. So these people are getting a rude awakening right now, trying to figure out, what am I going to do? Some of them have already spent the money, and now they're trying to figure out, what are we going to do here? So there's more to come on this, but in our tax shows, we're going to talk about a number of tax changes, things that have occurred as of COVID or because of COVID, but also just things like a GameStop trade, how disruptive those things can be when it comes to your tax bill or tax liability.
Oh, I would hate to be that person that uneducated made the trades, and not uneducated, but just didn't know what they were doing and spent the money.
Yeah.
Oh.
Bought a Ferrari that went down by 20%, and they don't have the money to pay the taxes on what they gained with the GameStop trade. So that's a double whammy. They lost money on the new car, and now they got to owe Uncle Sam.
Oh, that is a double
painful.
Whammy. Very painful.
All right, Sarah, it's been great. We'll see everybody next week on We're Talking Money Live.
Yes.
Thanks for joining us on We're Talking Money. Be sure to visit our website, www.omnistarfinancial.com, where you can learn more about how we provide value to our clients. Subscribe to the show and our newsletters, and drop us a line with suggestions for upcoming shows. If you enjoyed today's episode, we'd appreciate a rating on iTunes, or simply tell a friend about the show. This podcast is a publication of OmniStar Financial Group. Any information provided has been prepared from sources believed to be reliable, but its accuracy is not guaranteed, does not represent all available data necessary for making business or investment decisions, and is for informational purposes only, and does not represent or constitute any recommendations. All expressions of opinion reflect that of the authors and are subject to change. If this podcast contains any projections, forecasts, guarantees, and/or predictions of any kind, you're required to ignore the same. OmniStar is not engaged in the practice of law or accounting, and any information in this podcast should not be construed legal or tax advice. Any distributions, use, or copying of this podcast, other than the intended recipients, is unauthorized.